Hooty hoo, all my stock market gamblers. Welcome today. I'm Tall Mike. So glad you're here. What do we got going on? Well, we got the slow week, right? We're Christmas week. Hopefully everybody had a wonderful Christmas, but we got a short week this week, and then we got New Year's next week. Now, typically these 2 weeks are up weeks. 75% of the time they're up. They push the market higher in these 2 weeks. 25% of the time they push it lower. But the market's easy to push around these 2 weeks because of the low volume, because the professional traders are away, and that's usually why you get the push higher from the retail investors. We'll see how it plays out next week, but this week we pushed it up higher, right? Pushed it up higher. Now, what's the market going to do in 2025? Now, 2025 we're set up. Well, I think we're going to have a down year. Now, in real terms, I definitely think we're going to have a down year, meaning gold will outperform the stock market as it usually does, right? Okay, gold's outperformed you go back 20 years, gold has outperformed the stock market, but nobody likes to talk about that. But that's real money, that's real terms, right? So in nominal terms, maybe the Donald can, well, get the Fed to print enough money to push it up higher in nominal terms. But we've had 2 great years, 25% about a year, 50% in just 2 years up, right? And we've hit over 55 new highs this year on the S&P, which tells us that next year is going to be down year. That's just historically what happens. Now, I know the Moon Boys tell me it's different now, that we can never go down. We can only go up, and that's a possibility. We'll see how that all plays out for you. So that's the take on the stock market. Let's get over to the real estate market. Now, real estate, we talked about this a little bit. The real estate market for 2025, it depends on the jobs market, right? If the job market stays strong, which I don't think it's that strong. Matter of fact, we just had unemployment claims come out, and they were the highest in 3 years, right? So we're still getting a lot of people unemployment claims, a lot of people not working, a lot of people out of jobs, right? But we got the Doge boys. They're going to come in and they're going to cut a lot of government jobs. Now, just in September, we hired 787,000 new government workers. Now, I don't think we need those workers, so I think a lot of those workers are going to have their job cut. A lot of the jobs are going to go away. A lot of the retail stores that are going out of business. We see this with the party store. We see this with the dollar stores. We see this with a lot of retail stores going out of business. There are going to be a lot of job losses. A lot of corporations are having job cuts. So these jobs are going away. Now, if the jobs go away, people are not going to be able to buy a new house, right? People are not going to go out and get a new mortgage for 30 years when they don't have a job, right? Now, here's the thing. What we've got now is we got a problem in the credit market. Credit markets are starting to break. They're starting to break down. There's a lot of people getting turned down when they say they're not qualified for the loan, but a lot of these people actually could have qualified a year ago, but now the banks are not making as many loans, so they're rejecting them. They're turning them down. There's a crack in the credit market. Now, when the credit market breaks, it's going to be really bad for a lot of things. It's going to be really bad for the stock market, right? Going to be really bad for real estate market. You see, people buy real estate with debt. Real estate is a debt asset, so when people cannot get debt, now people interchange the words debt and credit. When they can't go farther into debt, when they can't get credit to buy the house, right? So anyways, when this credit debt market breaks, it's going to break. Nobody knows exactly when. They all know when it breaks, it's going to be just terrible, right? I mean, we're just going to go straight down, right? The housing market, the Dow, the S&P, they're all going to go straight down at that point. You see, back in the Great Depression, let's go back there for a second. Then the Great Depression, houses dropped 25%. Now in 2008, heck, we dropped 34%. Dropped more in 2008 than we did in the Great Depression. But what was the difference? It was the credit market, right? In the Great Depression, people did not have credit. They did not put 95% loan on their house. They couldn't get it. You were lucky if you got a 20, 30, 40% loan. Extremely lucky if you had a 50% loan. So that's why houses didn't break as much. They only went down about 25% because most people had 50% equity plus. Most people had 70, 80, 90, 100% equity. So they only dropped about 25%. But now we live in this debt-based society, right? Where we're in this debt market, and this debt market is getting ready to break, and people are going to see their house prices drop a lot when it happens. I hope it doesn't happen for another 3, 4, 5 years. To be honest, I don't think we have 3 years left before it breaks. We're starting to see the cracks in the credit market now. What am I talking about? Well, you see the cracks when they lower the rates, right? But the long-term rates go higher. They lower the rates. The Fed lowers the rates on the short-term market, right? But the 20-year, the 30-year, they're going up and up and up because nobody wants to loan money at 20 or 30 years, especially not the banks, right? Because they see when they lower the short end that the Fed is just waving the white flag to inflation. Inflation is going to take up. But Mike, you just said that house prices are going to come down. That's going to make inflation come down. There's going to be certain assets that come down. Anything related to debt, right? Anything that you need to go get a loan to buy is going to be coming down. It's going to be crashing hard. That would be your house. What's going to be going up? Food is going to be skyrocketing. The price of food, things that you need, gasoline, going to be going up, going to be going higher. Anything that you need is going to continue to go up. But the things you don't, the debt assets, like your house, right? Because people can't go borrow money to buy a house. Because remember, the credit market is broken now. They can't go get a loan. So what happens? Well, you go to what's called cash buyers. Now, cash buyers are going to knock this housing market down at least 40%, probably a lot more than that, but that's what I'm calling for, a 40% crash. So even though a lot of things are going to be inflating higher, your house is going to be dropping lower and lower, and cars are probably going to be coming down in price also. Why? Because people use a loan to get them, right? And those loans are going higher and higher. We got the crack in the debt market right now, and that crack is going to start to show up because people can't get car loans. They can't get house loans. Therefore, those assets are going to be going down when everything else is going to be going up. Now, I feel sorry for young people today. When I was just a kid, right? I mean, just my father worked. My mom, she stayed home. She raised the kids, right? We lived in a nice house. We went on nice vacations. We had 2 relatively new cars sitting in the garage. We could do all of this with just one income, right? And that was very common. It wasn't unique to my family. That's how it worked back then. One income, you could survive and you could have a very nice middle-class lifestyle, right? Well, the middle class has kind of been wiped out today, been wiped out by that thing called inflation, which they tell you we don't have inflation. They're telling you it's down at 3%. I'm telling you it's at 8% and going to pass 10% any day now. We're going the wrong direction in it. But as a kid, only one person, my dad, he would work, mom would stay at home, and we'd have a nice lifestyle. Today, you got 2 people working, 2 young people working. They don't have any kids to support. They cannot even afford the necessities of life. What has changed? Well, what has changed is the dollar. The dollar has broken, right? It's lost 93% of its purchasing power. That's not tall Mike telling you that. That's the federal government's own statistic. Now, they're going to wipe out the last 2 or 3%. They're going to do that at a quicker rate. So a lot of my friends that are retired now, they retired and they're happy because, you know, their Social Security check comes in and it's $3,000 or $4,000 and they can squeak by on that. You know, they can live, they can survive. But here's the thing, 10 years from now, they're still going to get that check for $3,000 or $4,000. The problem is it's only going to buy $300 or $400 worth of purchasing power because your purchasing power is going to be cut by 10 again, going to be cut by 10. The dollar is going to turn into a dime again. And it's very sad. Most of these people, they will not be able to survive. They will have to have help from either their children will have to support them. Maybe some of them will be lucky enough to find a job and they can go back to work, but there'll be a big retirement retirement crisis. We have the retirement crisis right now. A lot of people are retiring and they can't afford it. You see, over half the retirees, they don't have anything saved. They have absolutely nothing saved for retirement. So they're exclusively relying on the Social Security system. But the Social Security system is breaking at a very rapid clip, right? I mean, that system is insolvent. We don't no longer have the money. It's called an unfunded liability, and we'll talk about that in a later video, but those unfunded liabilities are spiraling out of control, higher and higher and higher, right? So we have 200 trillion of unfunded liabilities right now. Most of that's in the Social Security. See, Social Security, biggest Ponzi scheme in the history of the world, right? You paid in. All your working years, you paid in. What'd they do with the money? They went and spent it. They had a party with your money, party with my money. How much money do they have left? Not very much. See, when Social Security started, there was 18 people working for every one person that was on it. You know what it is now? 3 people work for every one on it. Soon to be 2 people working for every one on it. System's broken. It's not going to survive. It's a big problem, right? Now let's get back to the housing market. Everybody talks about housing and how there's this housing shortage. Now I would totally disagree with that. We have no housing shortage in the United States. Do you realize about almost 10% of homes sit vacant. Why are they vacant, Tall Mike? Well, some of them are rentals, that haven't been rented out. Some of them are owned by wealthy people. They do land banking. I actually brokered one of these deals. A person already owned 4 or 5 homes, but he put another $5 million into a house that he was going to let sit empty. You see, what this is a lot of foreign money comes from other countries. They get their money out of the country and they put it into the house. Now they're aware that house prices can go down by 50%, but that's better than what their country might completely collapse. Better than in the bank. The banking system might completely collapse. So a lot of these people are land banking and they have these luxury homes sitting vacant. A lot of luxury homes sit vacant. A lot of people don't know that. They only use them as vacation home. Maybe 1 month out of the year, sit vacant 11 months out of the year, but there's a problem, right? And it's not a problem, really. We could fix this tomorrow. You could fix this with the stroke of a pen, Mr. President. I'm telling you how you do it. Here's how you do it. Okay, so the normal people have this thing called property taxes, right? Well, why don't we raise the property tax for every non-owner occupied home? You pay one extra, your property tax on $1 million house, let's say $10,000 a year. Okay, now let's say you got that $1 million house and it's owned by a corporation. I think the property tax should not be $10,000. I think it should be $50,000. I think it should be 5 times. What if that home is owned by a foreigner? What if a foreigner came in and parked their money there? What type of property tax should they have? I say 5 times what normal is, right? Now, what about second homes? I say second homes, you should only be 3 times. If you're rich enough to own a second home, you're rich enough to pay 3 times the property tax. A lot of this will put the inventory onto the market. It'll stop the land banking. It'll stop the corporations. It'll stop the Airbnb people. Airbnb people, look at our houses were not designed to be hotels. They were designed for people to live in. So if you tax it, increase the property tax on anything that's not your principal residence, 5x it, I'm telling you, you get so much inventory on the market. But what would happen? We go down about 70, 80% in value. I'm telling you, house price would drop 70 to 80%. A lot of pain. A lot of people don't want that, so they're not going to do this, right? But they could solve this instantly, right? I mean, we got too many people that go and buy houses that don't really need the house, right? They don't need it. It's their second, third, fourth home. It's corporations buying. It's Airbnb buying. It's vacation homes. It's foreigners buying our houses up. Look, I got nothing against foreigners coming in and buying a house, but shouldn't they pay a little bit more than me and you? Look, you ever go to China and try to buy a house? I bet it's really hard. Matter of fact, I know it's impossible. They would never let such a thing happen. Do you realize most of the countries in the world would never let such a thing happen? In the United States, it happens every day. How do I know this? I'm a real estate broker. I sell it to these people, right? I mean, I see them. I see them bringing the money in from foreign countries, buying up our properties. I think they should have a higher property tax. 5 times. You're paying $10,000, they should pay $50,000. Yes, for the same exact house. Because why? Because they're not a U.S. citizen. Now, a lot of people that are in foreign countries that listen to me, they probably don't like this idea. A lot of people that work for corporations that buy houses to rent out, they don't like this idea. A lot of Airbnb people, they don't like this idea. A lot of rich people that are land banking in houses, they don't like this idea. But you can solve the housing shortage. We have no shortage. We have an allocation problem. And right now it's allocated to the foreigners, allocated to the corporations, allocated to the wealthy. And we can change this in one day with the stroke of a pen. You just 5x their property tax, and I guarantee you this problem will go away. The money, where would the money go? It would go to help the schools, go to help the infrastructure. Yeah, I think we need some of that. I think our schools could use some extra money. I think the infrastructure is really broken. Fix the streets, fix the bridge. It's a, fund the city police department, fund the fire department. A little extra money coming in from the people that are buying these houses that are not using them as their principal residence. 5x them, just my opinion. I'm Tall Mike. You like this stuff? Give me a thumbs up. Punch the subscribe button. Get out there, everybody. Enjoy the day. Bye-bye now.